Good evening, everybody. My name is Daniel Young. I'm the owner and founder of Adapted Perspective and the Adapted Perspective social media platforms, and I am back to talk about our investment strategy for the stock market using closed-end funds. So to get the normal disclaimers out of the way, it's an unedited video. Who knows what you'll hear in the background as I film these in my house. I'm not a financial advisor. I am a financial strategist, and I don't speak like the herd. I walk in limited company, and sometimes I walk alone. So the short update, or at least I'll try to keep it short. Short update, and then into strategy. The ebooks are an ongoing work in progress. The main strategy book is done. Currently working on the dividend book. Uh, Hopefully not adding a ton more chapters, but hopefully almost done with that. I want to work on a scholarship book, and then I take it from there. Uh, Outside of that, this week I finally caught up with our December budget, which wasn't hard. It's just a busy month. And then I had my own setback where I couldn't work on things for about a week because I couldn't see anything. My vision was not that great. So it's really just catching up from that. So I made it through December's budget, most of our investment tracking spreadsheet, and then started working with Grok and using that AI platform as a business coach, which actually works really well. ChatGPT is a better writing platform. It works as my sounding board, editor, proofreader, and final revisionist. And I've been able to tweak its personality into somewhere into the middle space, the middleman between more than the always positive yes man that he starts out as. Like if you're familiar with AI or you've dabbled with AI at all, it's always positive. And I tweaked Chat's personality too sharply and did not like it. That version of him and I did not get along. So I've since I've pulled back a little bit and retweaked his personality, and it's not a straight yes man, but it's also not the guillotine with zero fucks given. Um, we're in a good place, and it's been a very good experience using that AI model to help me write my books. Because don't don't check out on this because ChatGPT will easily write a book for you, and it will easily be obvious, or it will be obviously easy to see that it's AI. And I'm not about to claim AI is my own writing. When I look at memes on Instagram or Facebook, and they're generally, oh, it's like a catch-all ad. I mean, you've all seen them, um, and I'm not going to throw anybody under the bus, but when you read it, it's very one-line based and not paragraph. And once you pick up on AI, it's really easy to see it somewhere else. And somebody's just using ChatGPT to create their ad, which means they're not having to create a lot of copy. But at the same time, it's not their voice. And that's very easy to tell the difference between my voice and Chat's voice. Um, on the Grok end of things, Grok and I are in a good place. Grok is a much better overall business model and marketing model than Chat. They're still two very different AI systems, but they're also made for very different things. They can do similar things, but they're really made for different things. So my advice is if you're using an AI platform, if you're going to dabble or at least try it out, use that system for what it's best at and don't ask it for advice outside of its main purpose. Now, you can ask it for advice, but it may or may not give you the best advice. It's like asking people around you. If you wouldn't go to somebody else for financial advice, you're probably better off not asking that person for financial advice. And AI systems are very similar. They're created for a specific purpose. Use them inside that sphere of influence, and they're amazing. You ask him stuff outside that sphere, and things get a little more shady. Not shady bad, but just it's not what they're designed for. So, my piggybacked advice about that is to still pray about things because You want that guidance leading you and not AI's guidance leading you only. You want to, you still want to pray, you still want to worship, you still want to talk with God and get his advice, because once you make AI your prayer booth, altar, and echo chamber, you're going down a different path than I would advise you to go down. So, strategy wise, I want to start using some of the terms and wordplay that I use in my books. So, let's quickly review, or at least I would say review because I've already written it, but we haven't really talked about it yet. So, let's go over types of financial waters. Currents, financial currents, exist whether you like it or not. They're always moving. Waves are large events, recessions, wars, policy shocks, herd panic. Ripples are smaller disruptions. Tides are the long term consequences of choices, including your own. So this week brought forth some new waves, like President Trump reducing credit card rates to 10% through 2026, kicking big investors out of the housing market, and instructing Fannie Mae and Freddie Mac to buy over 200 billion in mortgage bonds that would hopefully reduce mortgage rates to under 6%. Those are big things. We saw some ripples, like the aftermath in Venezuela and those ongoing negotiations. You have Colombia's sudden willingness to come to the negotiations table, and you have Mexico's puppet asking for diplomacy. Riding the tide depends on the fallout of those events and the choices you make in the market. As it pertains to the market at large, we're still in, or we're still chasing, the same currents: bonds and bonds proxies, end to end energy, and technology beyond the giants. Those remain the best places for us. And it seems that a couple other services are finally catching on. I've seen several articles about energy being the play for the future, about other herd investors chasing Venezuelan oil, which isn't for us. We're chasing energy, not reflections or isolated spots on the water. I've heard more about infrastructure projects beyond the grids and a lot more. But for reasons still unknown, not many people are talking about the bond and the bond proxy bulls. Both are primed for liftoff. Slight dip because the herd's out roaming elsewhere. And you wouldn't really see it in the market at large based on that CNN Fear and Greed Index that sits at neutral. But noticing, I mean, I track prices week to week. If you're familiar with my videos, you see this. And tracking prices week to week, the bond market still, at least in the closed-end fund world, is down. That's an opportunity. So with the herd out roaming elsewhere, chasing technology, maybe Venezuelan oil, and who knows what else, that's fine. The bond market's down. Rates are being cut, and then more rates are predicted, and GDP is heating up. So the US is currently the top marketplace. So beyond bonds, right? That probably needs a better transition. But outside of bonds, the US is currently the top marketplace. Almost everyone wants to sell here. That's great for our blue chips and 5G tech dependent stocks, which is pretty much everybody at this stage. But you and I both know that some companies are better than others. So that just means we need to be choosy. And in a neutral market, or at a neutral sentiment market, it's not quite an all in position. The bond market is down. So the bond and bond proxy world, where you can find a deal, which there's a lot of right now, you buy the dip and don't overanalyze it. But in the grand scheme of things, with the overall fear and greed index sitting at neutral, it's not an extreme fear moment. So it's not really a pile in moment. Use your wits, use your wisdom as to how much you're going to invest. I know how much we have at our disposal to invest. On the cash brokerage side, we've got about 2,100 to invest. We can invest all of that. Now, that doesn't bother me. On the Roth end of things, with a primed account going into the year, so it's sitting at about 7 grand cash, I would not spend the entire 7 grand tomorrow. I would make targeted buys anywhere from say 2 grand to 3 grand, maybe even 2 grand to 3,500 now. Wait at least a month, and then go from there. Maybe not spend it all, but at least go from there. So, my point being, overall, right? Regardless of market, regardless of current, the strategy is to scoop deals in the present market, buying with the future market in mind. It's not a complete extreme fear moment, so it's not an all in moment. So while the herd chases isolated reflections, we're already in the current, or we're chasing the current, and we're being carried forward. That's the goal. So here's the closed end fund list for the week of my progress today. I also I finally got through updating the portfolios for the year, catching up on dividend amounts. So at some point, I would like to review portfolios, but that's not today. Let's see. So here's the target list for the week. All significant based on the current discount, each line significant on its own, not in relation to another. So if we go to the very bottom, you'll find some numbers in premium, and I generally don't buy premium unless it's a solid deal. I think I've only done it once or twice. I think I've only done it once or twice, but really the goal is to buy in discount. These funds, I'll preface, these funds are in premium and they're marked as triples because even though it's a premium, meaning you're paying more for what the individual share is worth, you're still getting a discount based on its average premium. 5.3, 10 is cheap, 7 is cheap. So since all of them have significant discounts, I like to sort by payment. Come on. And then I like to screen out based on this. FSSL is brand new. Like it just started. It's just like FC. Well, it's run by the same FCO, um, but it's brand new. I don't know enough about that fund. It's brand new. Most closed-end funds I've seen start off at pick a value and then they drop and then rise back. I don't know much about that fund at all. Um, so let's see. So I am not a huge Aberdeen fan. Liberty USA is on discount. Its sister fund ASG doesn't make the cut this week, but it would make the cut, or it doesn't make the cut on a triple asterisk as a current target. It would make the list as a dollar cost average move for us. I generally like to buy them in tandem. But also, if we bought it today, the first dividend we would see wouldn't occur till March. I want to say their ex-dividend date is the middle of January. That's right around the corner too. So I would probably pass on that this week. JRS real estate, it's got an off-cycle dividend. It's not my favorite cup of tea in doing that. So if I can pick up a monthly fund, that's what I prefer. So now with everything monthly, it's one thing to buy, trying to justify this or at least ration this logically rationalize this out last video. If USA and ASG were the best picks of the lot and better than any current monthly option, that's an easy yes, I would buy those funds. Like blue chip, technology based, prime to go within their ex dividend date, and nothing else really fit the bill, I would buy that. But in the current market with it still being bonds proxy and energy and blue chips, or energy and blue chips kind of flip flop, it's hard to pick that on a dividend I have to wait for. versus a dividend I can get this month or next. So with everything monthly, let's look at yield, and we'll cut out everything that's sub 9% unless there's a good reason for keeping it around. And there are two obvious keeps. HFRO, because it still has the greatest discount, it's come down significantly. I mean, almost 15-20%. But currently it's 40, we'll say it's 48% off. We'll round down. So that's like paying 52 cents for every share invested. And then we come up RFI. It's a, I don't want to say it's a flat dividend, but it is a insanely consistent dividend. It occasionally it pays hidden yields, but it hasn't paid a hidden yield in a while. But regardless of what the market does, they just pay the dividend. And with it being pretty much the same price, if not a little bit less than where we bought it the last time, it's tempting right now. And it fits the mood. That's a bond proxy. So you have HFRO, uh, mainly North American real estate. RFI is global real estate, but also, I want to say, mostly North American real estate. RLTY has a very similar portfolio to RFI. Yes, it's a closer 9% dividend. It's also closer to $3 more to, and it's not worth it to me paying that much more. All right, so here we go. As we slowly weed out the list, NBXG is 5G tech. CIF is bonds, and it's a pendulum bond fund. It's a roller coaster fund, meaning it generally tracks how the interest rate market goes. So with higher interest rates, the price fell down. With lower interest rates, the price goes up to about 293 $293, maybe a little bit more than $3. I bought it on a roller coaster knowledge, knowing that so long as rates were high, it would be low. But in theory, that's the hope part of things. And I found that I don't like roller coasters. I'll write it because I bought it, but I don't like roller coasters. The waiting of this to actually to respond to the market and come back up has been frustrating. We haven't owned it that long, um, but it's been frustrating. That said, I mean, it pays a great dividend. Doesn't seem like it does just because of price, but you're getting a low buy-in price and a correlating dividend. But still, I mean, it pays well. Um, yeah, it just the roller coaster of it is not my cup of tea. You could also say the same for ASG and USA. Those seem to have bouncing or roller coaster profiles. And pending your strategy, that might impact how you own the funds. The ADX is a blue chip fund that just grows. That seems like a much more long term worthy investment for me, like a buy and then add more to it when it qualifies. ASG and USA seem like short term patterns. I'm either holding it for the bounce or holding it for the roller coaster or the wave, whatever terminology you want to use. So I'm buying it towards the trough, and then I'm selling it towards the crest, profiting it, pushing the money forward, waiting for it to hit another trough, or you're just riding it throughout, collecting the dividend as it goes. All right, but CIF for me is not going to stay. FHTY is not going to stay. I mean, yeah, it's not going to stay. PTY, PIMCO fund. I have tracked PIMCO for a while. The funds that have been on my wish list are PDI and PDO. And that's not to say PTY isn't great. Um, I mean, their funds are just set up well. I'll expand this out. You can pause it and read it and see what you think. Um, let's see. But it's not been on my specific hit list. PDO will stay. Maggie is another term fund, but it's all utilities. That would stay as a bond proxy. RA, we don't. is a bond fund. I initially thought RAUs was all investment, but it's or all real estate, but it's all bonds, and we already own plenty of bond funds. That I would add PDO as a bond fund. I would add DLY as the sister fund of DSL. I would add those for sheer name recognition, um, but not RA. But that's just me. PIMCO is another PIMCO fund. We can leave it on the list because it's so cheap overall. You know, of the different PIMCO funds, under $5 a share is pretty darn cheap. It's a little bit higher than its average. I mean, the 52-week average 441, 5 is close, but if I'm being stingy, it doesn't make the cut. HGLB, I am tempted. I've held out and spoken, maybe not against. I've 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 been hesitant to stay invested in HGLB based on their portfolio, but I found a new addition that gets me excited. They invested into some Texas data centers, which hold promise. The I My last journey into their portfolio, I mean, I like what I see. It's more portfolio in a can than I like, but I do like what's in there. So it would stay on the list. NPCT is another bond fund. We're great on those right now. FSCO is labeled a bond fund. It's an all U.S. bond fund, but it's really a private investment or a private lender fund or a BDC fund, which is great for the current market. River has more BlackRock than I would like. Um, it's another term fund. I want to say I've talked to somebody at some point about owning WDI. We went with Meggy instead, and even a DNP, which did not make it this list. But that's not to say WDI isn't a great option. What makes me hesitate is the CLO side of things. Oh no, I'm confusing portfolios. We we went with I thought it was a utility fund. That's really strange. All right, so on the utility end of things, yes, we went with Meggy and DNLP. I don't know what I'm confusing that with, but on the CLO front, as cheap as you can find CLOs right now because of how crazy that market space is, I would not be there. Um, I am all for being on my lonesome. I am all for being where nobody else is. But at the same time, the CLO space right now is like at the very back, like of the payment schedule, I guess you could say, in bonds and secure all of that stuff. It's like at the very bottom, and everybody's still pretty wigged out about that market space. So I will say no to that. Hicks is almost always in discount and doesn't beat the market at large. PDI is on my wish list. BRW we already own. The CLO grouping, I mean, I get it. 10% discount. It pays a crazy dividend. That 32% dividend is amazing. OXLC used to be very differently priced. It was like $3, $4 a share. And it then the market just dropped out. They did a share buyback. When we transferred our portfolio over, we owned it. We still own it in the Roth and in the cash brokerage. Fidelity got a much better transfer price than Webull. Um, Made a much better transfer price. I want to say the Webull transfer price when they did the reverse buyback was close to $20 a share. We own it. It pays a fat dividend, but the pricing has yet to come back. I mean, with lower rates, increasing GDP, I would love to see the CLO market space stabilize. I would love to see the price come back. And at the same time, if it came back, I would honestly probably sell it. Um, but for the time being, it's a great fat dividend. So that leaves River's still there. So let's see. Real estate, real estate, bonds. 5G tech, bonds, utilities. It's portfolio in a can, but it's heavily tilted now toward technology. You've got midwave wireless, you've got satellite and 5G data management. You've also got software centers and data centers. So much more technology based than simple real estate. FSCO is BDC, PDI is bonds, BRW is my. It's not a catch-all portfolio when it can, but it there we go. It's that, but it's also the shareholder activist fund. So what would we buy? What would we buy, or what would we buy in each portfolio? So I left what we have as cash in the cash brokerage. The Roth has about 7 grand in it, and I would probably buy differently. The Roth, I want, let's see how to say this. So I actively manage my portfolios or our portfolios. So in having a no withdrawal portfolio, that's not, or that doesn't mean that I'm not actively managing it. I'm paying attention to it. I'm taking away, I'm adjusting as needed. It's very fluid on acquisitions. Like you're not, or at least our structure, you're not selectively buying based on rigid allocations like a 60/40 portfolio. You're buying the best deals in the current market. So I want a like a U.S. and international bonds portfolio, really a bonds and bonds proxy portfolio with long-term blue chip or long-term end-to-end energy. Energy is very cyclical. I mean, all of it's cyclical. Energy is cyclical, bonds are cyclical. Um, but I would go more U.S. and international bonds. I would go ADX over USA and ASG. I would pick 5G tech like NVXG, um, but not necessarily outright energy like in KYN or NML that we own in the cash brokerage. In the cash brokerage, it's a little more open. I'm okay with short and long term blue chip. So I'm okay with ASG, USA, and ADX all being the same thing. They all pay on that off, they all pay an off cycle dividend. Um, I'm okay. Yeah, I'm more okay with, I don't know how to say it. Like I would pick more short and long term blue chip. I would pick more energy. I would pick less international bonds per se, and make it more just uh, U.S. based. But I'm also willing to. I'm willing. I'm not willing to dabble. I don't like the roller coaster. Like the CIF we picked up in the Roth, maybe we would have picked it up in the cash brokerage. But the more I learn about me, and the more I learn about my comfort level investing, it's hard for me to play the roller coaster game. We bought ZTR on a roller coaster bid, and it's not responded like I thought it would. CIF on the roller coaster bid. Yeah, ASG and USA they bounce based on so uh, like FCO it just pays. Um, ZTR pays, but it cut its dividend based on rates and pricing. Um, so enough of my wiffle waffle. So what would I buy in the cash brokerage? It's hard to pass up on what I've already said. So BRW, FSCO, HGLB, and honestly, HFRO, and even RFI. I would look specifically at that subset and look at the configuration that gave me the best. I don't want to say total shares, but it would give me the best overall dividend out of that mix. So Like we have 1,700 shares, I believe, of BRW and FSCO. I can pick up, and this will be off, but at least you'll see it. So I can take my total investment and subtract from it the sum of these things, and it'll give me a rough total. So BRW, we could pick up 100 shares. FSCO, we could pick up 100 shares. HGLB, I can't buy 100 shares of. I could buy 100 shares here, or I could flip flop back. I could buy 200 shares of that, right? And then you can track dividends in this nifty little spreadsheet. You can track overall dividends here. Let's see, at 241, that's not enough to buy 50 shares of the others. I could buy 100 shares of one of these other guys. Or honestly, I could just pick 200 shares and call it a day. If I was going to go a partial buy-in off the Roth, it's tempting to pick one of the funds I've tracked so long. But at the same time, I mean, the Roth in size is not, it's not near as large as the other brokerage account. It's new. Well, I won't say it's newer per se, but it just doesn't have the same money in it. And it is limited on how much you can put into it every year. Um, but it's same thing. Like we already own funds, so it's hard to look past those funds. Like PDI versus PDO, it's got a better dividend. This has a better buy-in price. They're both great funds. DLY, we own the sister fund. Do I want to pick up this one? I would love to. It's a different portfolio than the other one. I don't want to buy like RFI and RLTY. Buying the same portfolio for $3 more just doesn't make sense to me. So yeah, DLY and PDO, pick up both of those funds, right? 200, can't do that. I can do that. That leaves me, it'll leave me a little bit. I doubt it'll be six. Let's see. 61 puts that as a little bit more than 600. Maybe it's enough to pick up 100 shares of HFRO. Maybe, maybe not. Um, we can look at the overall dividend yield. Let's see. 1021 off two buys, not a bad deal. I know that's not the original amount. It's not my point. So on my end of things, would tomorrow be a buy-in day? I think so. We could buy tomorrow and I could figure this out. On your end of things to remember. It's not an all-in moment. Any you've got to, whether you agree with the currents or not, they're always flowing. So you've got to find the best current to be in and then optimize your overall income. And in doing that, I don't want to say it doesn't matter what you pick because it does. Like you want to buy the stuff that's in the current. You want to buy stuff that's flowing in the current with you. You don't want to buy stuff way off and who knows where. That doesn't help you. That's what the herd does. We don't want to do that. But so long as you're sticking inside the zone, any number of these funds fit the bill, whether you own them or not. But if you already own something, and this is on my end of things as well, if you already own something, it's really hard sometimes to pick a new fund. It's tempting for sure, PDO, DLY for sure. But as tempting as it is, and as on my end of things, as tempting as it is, sometimes you have to look at it not not that it's envy or coveting something you don't have, but it's the lure and temptation of buying something that's been on your target list for forever, but it might not be the best deal in the current market. Like if I really went back and looked at it and I looked at the pricing and the overall graph and I looked at where PDO is now, it's a bond dip, but it doesn't look like that on the fear and greed index because it tracks the entire market. So if I it is PDO a really good buy right now based on its pricing history? And that I don't know. I'd have to go back and look at that. Same thing for DLY. I know the others are great buys based on where that price point hits with our current portfolio. So make the best decision for you. Buy the dip. That's, I mean, my advice, whatever you pick, buy, do your research, logically think it out, make sure you're in the right place, right? Or you're in the right current, headed the right direction. Make your selection and then let it go. It's very easy to get lost in chasing data every single day because I've been there. I love data. I love tracking data. Part of my job is tracking data every single day. But when it comes to finances and stuff like this, the budget, yes, track your budget every day. Keep up with that. Pay stuff off like that, yes. But investments wise, it, in this model, we're chasing income and long-term income and building a no withdrawal portfolio where we don't have to track it every single day like a day trader tracks that scrolling average of whatever price point, like every minute of every day. It's so easy to get lost in that and really like lose your day in that. Not that it's a bad thing, but like you get so engrossed that you just don't do other stuff. So point being, buy the dip. And Brett Owens said that during the tariff dip, it matters what you buy, but at the same time, you could pick almost anything in the bonds and bond proxy box and still come out the other side of the dip in a good place. But that's where I think it matters that you really know you have a better focus point or a better system or a better screening method in place than just randomly picking something out of a barrel of funds, right? So we filter the funds down, we optimize our money, we pick the best deal in the current market inside a specific current. And those three currents, bonds and bonds proxies, end-to-end tech, and 5G tech or technology, AI, 5G tech. But of those three, in general, the best deal is currently bonds. That's the dip. NBXG has gone up in price. Those other guys didn't stay on the list. So the best deals are the guys that sit at the very top of the list. You could argue for the utility fund. It's a bond proxy. And I get this one's at the bottom, but it's still got the best discount. And I've been through the HFRO justification on plenty of videos in the past. But if you wanted to play just the discount game, that's the top four. Excuse me. That's the top four. The difference is that's about half off, or compared to Meggy. But I mean, I could just as easily fight for RFI. So on my end of things, the top three and the bottom two are the best buys for me. There's no way I can buy them all with just $2,100, especially because I like to buy stuff. I like to buy sets of 50. I really like to buy sets of 100 lately, but I like sets of 50 and 100. Um, it's hard to buy the other stuff. And what I have to look at is if it's really that big of a deal, price wise, between PDO and DLY and the grant and their pricing history. Yes, their current price, current dividend, like their current discount makes sense. But I do want to see how the current price compares, at least in the last year of things. Like if it's significantly down right now, then that's a good buy. And I would consider adding that to the Roth. But if they're not great buys for right now, then that changes my focus. It thins the list a little more, and then I would pick different funds. So make the best decision for you with the knowledge and the wisdom you have. And if it makes sense, if you can logically justify what you're picking and why, end of story, make your decision and move on with your life. So that's really what I have for the week. And I'll just keep showing the screen. It's for me in the week, just like you, I have a ton to work on this week. And I know you do too. So don't get lost in your selections. Ooh, I wonder my notes. Yeah, you can see everything. How to update the portfolio, but that's okay. Neither here nor there. Uh, I have a lot going on. You have a lot going on. I wish you a productive week. If you feel weighed down, take a deep breath, take the break you need, and then get back to it. But quite honestly, it's not going to get done by anybody else. If you're tasked with doing something, the job is for you to do. So take the break you need. Don't wait too long. Come back and knock it out and make progress on your list. I've got stuff got to get done. So I'm in the same boat. So I wish you a productive week, and then I will see y'all on another video. So I wish you well, and I will see y'all later. Bye bye.